Hello, I'm Sherry Penner, Deloitte Private's tax leader for Canada. I am pleased to share with you the second in our series of videos addressing the federal government's proposals on tax planning using private corporations. Two of the proposals introduced on July 18th relate to capital gains and were largely aimed at preventing the extraction of corporate assets at low tax rates. Prior to July 18th, this could be achieved in various ways and was commonly referred to as surplus stripping. The first change proposed in this area relates to capital gains realized on the sale of shares between non-arm's length parties, whether they be individuals or corporations. Prior to these changes, rules already existed to recharacterize capital gains as dividends in certain circumstances where tax was not otherwise paid within the related group. Many tax planning strategies have been used successfully to avoid these rules, such as post-mortem pipeline planning and certain other compensation strategies. Some of these transactions have been publicly challenged by CRA, but successfully upheld by the courts, thus prompting the proposed changes. If enacted as currently proposed, the new rules will apply as of July 18th and will change the way we calculate the cost of shares going forward. The new calculation is complicated. It can result in higher or even double tax for related groups, as well as tedious multi-generational tracking requirements. Taxpayers that are conducting or considering any sale of shares, intergenerational transfers, or estate planning should discuss the implications with their Deloitte tax advisors. The second change proposed in the area of capital gains introduces a new rule aimed at eliminating tax-free capital dividends paid to non-arm's length shareholders by recharacterizing those amounts as taxable dividends. While this new rule appears to be intended to prevent corporations from recognizing capital gains on non-arm's length sales, the legislation as drafted could have far broader application. In fact, it could affect the payment of any capital dividend, regardless of whether it arose on a non-arm's length sale or an arm's length transaction. The new rule proposes to apply criteria to determine if a capital dividend paid should be recharacterized as a taxable dividend, including, first, was the dividend paid to a non-arm's length Canadian resident individual? Second, was there a disposition of property or a change in paid-up capital as part of the transactions? And third, was there a significant disappearance of corporate assets where one of the purposes was to avoid tax? The ambiguity of these criteria and the significant tax impact of a non-taxable capital dividend being recharacterized as a taxable dividend have created considerable concern amongst taxpayers, particularly given that these changes apply to capital dividends paid on or after July 18th, regardless of when the gain transaction occurred. Therefore, we encourage you to consult your Deloitte tax advisor before paying any capital dividends. I hope you found this summary valuable in understanding the proposed tax changes related to capital gains. We look forward to sharing additional insight with you in the coming weeks and remain ready and able to help you navigate these changes.